Hey guys, I'm David Mitchell, founder and CEO of TRADEway. What if God himself gave you a blueprint for how to handle your money? Well, the Bible is a practical book. Let's dive in and see what it has to say about wealth, about risk, about leverage, and about investing, and uncover how trading in the stock market can be a powerful tool for moving towards your biggest goals. We're so happy you're here. This is The Word on Investing. Hey guys, great to have you with us again today. If you were with us last time, you know we've been covering 3 great ideas that give you the potential to have great trades in the stock market. And these are concepts that our family's passed down for 5 generations now. And about 15 years ago, we decided to go around and share these with our brothers and sisters in Christ around the country. It's been great. But they have to do with this. Number one, the 3-legged table. And if you remember, we talked about fundamental analysis, technical analysis, and market tone. And the second great idea was getting the math on your side, where you're taught to win big and lose little. And then we covered how to leverage the big boys. Now, if you missed any of these, you can go back and catch a previous episode. Okay, so for today, what I'd like to do is go back and take a look at the 3-legged table in a little more detail. So remember what they are: fundamentals, technicals, and market tone. So let's take a look at fundamental analysis first. Now, fundamental analysis, this is something that you actually can learn in an MBA program or business courses in college. They really don't teach you how to trade at all, but they do teach the one aspect of a good trade, fundamental analysis, and they even teach you how to do ratios and different things like that. So I'm going to give you an example of what I mean by ratios. The thing that you need to know is you don't need a business degree because they don't really teach you to trade. I mean, I learned that from my grandfather, and he was doing it, and the guys trying to talk about it at college weren't doing it, and they were just giving you some concepts, and they really don't give you all 3 legs of the trading table. They just talk about fundamentals is all they talk about. And just as it's true, their own studies show that technicals won't do it by itself, neither will fundamentals, but they don't talk about that. You know, it's really funny. It's almost like a cult, but it's like they've got their own ideas, and most of them are not traders, so it's kind of interesting. But it's very valid, though, this concept of fundamental analysis, and what they teach about that is valid, and it is a component of what we need. So let's talk about it. You're going to have 3 major reports that companies are required to put out, and the IRS requires it, the SEC requires it. They have to do it just to run the company, and that is a balance sheet, an income statement, and a cash flow statement. Now, when we're talking about ratios, there are ways to take numbers off of, for example, the balance sheet, or numbers off the income statement or the cash flow statement, or you might take one number from the income statement, a different number off the balance sheet, and either multiply them together or divide them into one another, and you come up with a ratio that you can compare to other similar companies. And one of the first things you want to remember is that you have to compare apples and apples. So you wouldn't want to go in and run an earnings per share ratio for Boeing and then compare that to Amazon. It just won't work. So you could compare American Airlines to Delta Airlines, though, and see which one has the best earnings per share. And there are a lot of other ratios you would look at, but that's just one example. And the one with the best ratio is the one you would choose, all other things equal. So you kind of see how that works. And keep in mind, any companies we use in this episode, or any episode for that matter, are just purely for academic examples. They may not be good stocks to look at today. So it's just for academic examples. Now let's take a look at some of these ratios. We have 4 major types and then subsets under each of these. So there are many, many ratios. We have liquidity ratios that sort of check whether the company has enough cash flow or not. And we have activity ratios. And we have debt ratios. Debt ratios are pretty obvious what they are. Do they have too much debt, or do they have the right amount of debt? And then we have profit ratios. Are they making money, and how much? And is their profit growing quarter by quarter? And then activity ratios, to go back to those, that just has to do with things like maybe inventory, things like that. What are they doing in the company that requires the management to watch over it, and how does that compare with other similar companies? So each of those, the liquidity ratios, activity ratios, debt ratios, and profit ratios, each have maybe multiple ratios in those subgroups. So there are a lot of them. Now, I want to give you an example here of a couple of ratios, and a really important one is called the earnings per share ratio. And what you do then is you go out and you put, I'll just give you the ratio first. It's net profit after tax divided by the number of shares outstanding of a company. So the numbers of shares outstanding is really only listed as a footnote, perhaps on the balance sheet or maybe even in some other of the company's notations. But the net profit after tax, of course, is the bottom line of the income statement. So you're pulling a number off the income statement. In other words, what is their profit after you take all the money they make, you subtract out the expenses, including the tax. What's the bottom line? Are they making money? Well, you put that number in the numerator, and you put the total number of shares outstanding of stock in the denominator, and you do the math. So let's just use a silly example. It's not a real company. Let's call it XYZ Company. And let's say that the net profit for the whole year after taxes was $42,000. And let's say they have 6,000 shares of stock outstanding. So you divide 42,000 by 6,000, you get the number 7. And 7 would then be the earnings per share ratio. Now, if you compared that to similar companies, the higher the number, the better. So if you had 3 companies you were thinking about investing in and you know everything about them and you're trying to decide which one's the best one, all other things equal, the one with the highest earnings per share would be the one you would look at. Now, there are many other things to look at, but that's just an example. Now, what's interesting is there's another ratio called the price-earnings ratio. And so you take the answer from the previous example. In other words, you take the earnings per share number. In this case, it was $7 per share is the earnings per share. And you take the current price of the stock right now. Normally, what people do is they'll take the closing price of the previous day, where the stock closed the previous day. You put that in the numerator, and you put the answer to the previous ratio, which was 7. The earnings per share was 7. And you put that in the denominator and you do the math. So in this case, it comes out to be 10 divided by 7 equals 1.43. So there's the price earnings ratio. Now, in this case, you would compare this to other similar companies, and the lower number would be better. For example, if one company had $1.43 price earnings ratio and the other one had $1.20, the 120 would be the one you would choose. Why is that? Because it's showing that you're getting a better deal on the stock. So that's kind of how you look at those. Now, what's interesting, I chose these two for a reason, and there are so many of these out there, but I chose these 2 ratios because the earnings per share ratio is the one that a whole group of investors look at, and the price earnings ratio is one a different group of investors look at. So you have these 2 big groups, and most of you know I'm in the ministry, right? I've been a pastor for over 35 years, probably pushing 40 years. Time flies when you're having fun, right? You go out there and you realize when your grandmother was 20 years old in these little communities around Texas, one year all the Methodists would come over to the Baptist church and have a revival meeting. Then the next year, all the Baptists would go over to the Methodist church and they would do the revival meeting there. That's how it used to be, right? Well, now the Baptists and the Methodists don't like each other, right? They're not going to go to church together. And that's kind of sad, but that's how it is. Now, that's kind of an example of how these 2 groups are in the stock market. You have one group called growth investors, and you have another group called value investors. Now, I'll tell you this, most of the people coming out of the MBA programs, which then means a whole lot of your big boys out there that are trading millions of dollars for clients or for companies or for Baylor University or whatever, they tend to be value investors, and they like to go out and find when a stock is cheap and then buy into it. And they'll use the price earnings ratio to figure out when the stock is cheaper than other stocks in the same industry group. All right. Now, the other group of investors are called growth investors. And that's what we're going to teach you to do for most of your shorter term trading. Now, understand there are 2 concepts. There's long-term buy and hold investing. They tend to use value stocks more often. They turn to the price earnings ratio to discover the best ones, right? And then trading, which is shorter term, and I'm not talking about day trading. We never advocate that because I don't think you can win at it over time because you're competing with the best traders in the world, which are the floor traders. on Wall Street. You can't beat them over time. So I don't believe in day trading, but different stocks show you when they like to cycle. So you can find great potential entry points and exit points on your charting software. And those can be shorter trades. They average sometimes 2 weeks long, 3 weeks long, all the way up to 6 months. But you're not buying and holding, you're doing shorter trades. So we're going to talk more about the difference there. But when you're doing that style of trading rather than long-term buy and hold investing, you tend to want to be a growth investor, not a value investor. So what does that mean? We're going to only trade companies or stocks that are stocks of companies that have great earnings per share growth quarter to quarter and really double digit or better. So they're growing, 22% higher earnings per share this quarter than they had last quarter. That's called a growth company. Now, another definition for a growth company, let me give you an example that works better. Let's take Coca-Cola. If you go back several decades, when Coca-Cola was only in the United States, it was a growth company at that time. In fact, Warren Buffett bought mostly shares in Coke is how he got started. And back then it was a growth company. And that means it hadn't gone into South America yet. It hadn't gone to Europe yet even. And it certainly wasn't in China yet. Well, now it is. So it's no longer a growth company. It's everywhere already. So now it's sort of a value company. But so what you want to do is find the new Coca-Colas. Like who is it now? What company is it right now that has the potential to be a great enough company to grow into the whole world, but it's not there yet? And that's another way you look at what a growth company is. And some of the great growth companies that are still growing out into the whole world today would be like Amazon. Even Apple is still growing out into the world today. And so Apple, Amazon, Netflix, these have been growth companies that have been great in the past couple of years. So eventually someday they'll just turn around and be a blue chip, and value investors will be looking at them, but not us, because we're especially when we're talking about short-term trading, we're going to be looking for the new growth companies. Now, a lot of times you haven't heard of these little companies. And so we have rules for how to know if it's a good growth company at TRADEway. In fact, one of the great things I'm going to tell you, and I think I'll get into this idea right now, is can you imagine, would you really want to spend all your days doing hundreds of ratios, calculating ratios on hundreds of companies, maybe 10, 15, 20 ratios on 100 or 200 companies to figure out which ones, number one, are growth companies, and number two, which ones are the best ones? You probably don't want to spend your time doing that. So the great news is this. If you go out to TRADEway.com and you sign up for Insider Plus, this program is amazing because when you become an insider with TRADEway, we're actually going to do the fundamental analysis for you so you don't have to do it. You don't have to crunch all those ratios. And we're going to actually provide you a couple of great lists. One is a list of stocks less than $30 per share that have good fundamentals. And secondly, a list of stocks over $30 a share all the way up to $300 or $400 a share that have fantastic fundamentals. We call that the A-plus list. And that way you have two different lists of anywhere from 50 to 100 or more stocks that we've already placed in those baskets that have fantastic fundamentals. They have great leadership. They have great products. Their earnings per share is growing double digits usually from quarter to quarter, and many other ways we test them to put them in that list. And we keep those lists current. If you're an insider, those lists get changed at least once a month, and we pull out the ones that aren't doing so well, put in the new hot stocks. So you have a basket to choose from, and that takes care of the first leg of the trading table, fundamentals. So you don't have to do all that work. We do it for you when you become an insider. You can sign up for that, register for it at TRADEway.com. So when I was a young man, I used to have to crunch these numbers all the time. I kind of liked it actually, but now I realize that my time is better spent looking at the technical analysis, looking at charts and finding out which stocks make pretty patterns and which ones are regular and repeating and look like something that where the probability math would show me I have a good potential stock to trade in. I'd rather spend my time doing that, and really we'd rather you spend your time doing that than crunching numbers on the fundamentals. The great thing is there are companies out there that provide these services. They hire young people straight out of the MBA programs to crunch all these numbers, and then they make them available. So we've got several places we go and we can grab this information, but we coalesce the best of it, put it together for you. in a thing called the A+ list under the Insider program. So keep that in mind, because that's going to give you your basket of stocks, and it's going to take care of your fundamental analysis. So it's pretty cool. You're going to get several stock lists when you're an insider, and several different ways to grab that. We even have a way you can import it into your charting software and pull in the A+ list for both the less than $30 stocks and the greater than $30 stocks. So that takes care of this problem of needing to make sure the company has great fundamentals. Now think about this. Why is it important, though, that they be, number one, growth stocks, not value stocks, but growth stocks? And see, you wouldn't find that on your own, because almost everything out there, if you went out and you tried to search for good stocks, they're going to show you value stocks, because that's what they learned in the MBA program. But what our family has learned is that for trading purposes, where you need the stock to have some movement, you actually make money off the movement, whereas most people are afraid of the volatility. That's what gives you the potential to make money. So we teach you that the growth stocks have that potential, and they make more movement, and they're more volatile, and they're also growing quarter to quarter. So if it has the potential to be moving up just because of the profit growth, that's what you want to look at. It gives you more power. So, when you think about it, value investors, they're looking for cheap stocks. Well, sometimes stocks are cheap for a reason. They're no good anymore. Their products are no good. People don't want them. Their leadership is faded away, and they're just not staying up with competition. So that's why I don't think the first place we look is for cheap. We don't want cheap. What we want is quality. We want a stock that's growing, that has great leadership, that has great products, that's going out into the world. And we want to find, through our technical analysis, then once we've discovered the ticker symbols, by the way, that's the 2, 3, or 4 letter symbol for the company. And we'll be helping you know what the ticker symbols are for these great companies. But we want to find tickers of companies that are actually growing, that are growing out in the world, and have the potential then to move up if you're doing an up play, for example. So think about it. If you're doing a play where you make money if the stock goes up, you want a stock that's more likely to go up just because of the fundamentals. I mean, just the fact that they have great fundamentals makes it more likely to go up. So you're getting the probability math on your side. All right. So then once you have a basket of those, which we're going to provide, like I said, through our Insider program, the next thing you need to do is just go through the basket and start putting them in your trading software and looking at the technicals. And that's what we'll be talking about next time, is technical analysis and exactly how you do that. So think about it. What if you had a basket full of stocks where the fundamentals have already been checked, and those stocks have the potential to move up more than other stocks because they're better companies? They have better leadership, better products, and so forth. And we've run the ratios, and they have better ratios than the other companies. Wouldn't that be cool? Well, that's exactly what we're going to provide for you. And now, if you're like me, the fundamental analysis kind of gets a little boring. It's finance is what it is. And it's necessary, but it's not the fun part. So it's cool that TRADEway does that for you. The fun part is the technical analysis, and we're going to get into that in the next show. So we hope you'll be with us. Thank you so much for being with us today. And I want to remind you, when you go out to TRADEway.com and you sign up for Insider Plus, we're going to help you with that fundamental analysis, which is a huge benefit because it saves you so much time. And we're going to help you be so good at technical analysis as well, and even provide market tone information through those market alerts. It's like getting an ongoing education and this amazing support system where you have coaches that can help you. Like, what about placing your first trade? Wouldn't you like someone to hold your hand? So we can do things like that. You're going to get market alerts every day. You're going to get industry rankings and all these great things. So even if you've never traded stock, if you go out and you sign up for the Insider Plus program, it's going to help you get started right now. And I hope you love this show. If you did, please go out and rate and review it. And that way like-minded people can find it. And we hope you have a great day.